Investing in 2024 is getting weird, very weird. So please do yourself a favor and do the following before every trade in your brokerage account. I want you to clearly identify if what you are about to do is A, long term investment, or B, short term trade, or C, gambling. And yes, I did just say gambling. Let's dive in. Long term investment. We are all familiar with long term investment. It's the purchase of asset, stock, and ETF with the intention of holding them for a long period of time, typically years or even decades, with the expectation of generating return over that time frame by stock price appreciation and collecting dividends if any. Most, if not all, long term investors rely on fundamental analysis of the stock as a strategy to determine the true value of the asset. This involves reviewing financial statement, earning growth, revenue trend, and profitability ratio to make informed investment decisions. Examples of long-term investments include purchasing stocks such as Apple, Microsoft, Nvidia, as well as ETFs like S&P 500, VOO, or the Nasdaq 100, QQQ, or any other ETF, and holding them for years or decades to collect returns from growth of the companies and dividends. Options can also be used for long-term investment, whether it's being used to get a better price when buying a stock you like by selling puts on that stock, also known as cash secure put, or the more common approach by buying a long call, known as leaps. Leaps are basically calls that last longer than a year, often up to 3 years. Short term trade. When it comes to short term trading, it can be any trade lasting between few weeks to just under a year. It could be that you want to capture the bounce up on a stock that you believe it's oversold or shorting a stock that you believe it's overbought. Although I don't personally recommend shorting stock. Most, if not all, short term traders rely on technical analysis, which help them identify favorable entry and exit points for their trade. This involves reviewing price charts, support and resisting levels, moving averages, and RSI, just to name a few, which the trader uses to forecast the future price movement. Example of short-term trade include day trading, swing trading, and option trading. Options play a big role in short-term trading as it can magnify both your gain and your losses. Successfully predicting even a small stock movement can result in a larger return thanks to options. And finally, gambling. In recent years, there has been a rise in a new type of short term trading, assuming we can call it trading, that doesn't really rely on stocks fundamental nor the stock technical analysis. Instead, it's relying purely on chances or luck. Gambling in the stock market is when people invest without really looking into what they are doing. Instead of doing their homework and making smart choices, they just take a chance and hope for the best. It's like rolling the dice and hoping for luck to be on your side. Gambling in the stock market include high risk movement, emotional decision making, lack of research, short term focus, speculative behavior, and finally, lack of risk management. An example of gambling in the stock market include like purchasing penny stocks, day trading without a strategy, speculative option trading, over leveraging, following herd mentality, and ignoring risk management. Options play a critical role here, where a bet, buying a call, or a put for the short term can result in multiplying your money by 2, 10, or even more in extreme cases. Unfortunately, most often than not, you end up losing all your money in these short term trade. Unless you have an inside information or an unfair advantage, it's not a sustainable strategy. Now, I'm not against gambling in the stock market, since I do enjoy going to Las Vegas and exchange a few $100s for hours of fun on my favorite slot machine or playing video poker or even craps. But before you jump into any gambling bet in the stock market, I suggest you do two things. First, clearly label your trade as a gambling bet and do not lie to yourself about it. And secondly, set a limit and never exceed it. Remember, over time, the odds will be in your favor as an investor and not in your favor as a gambler. So, where I want to go with all of this? Well, selling an option like cover call or cash secure put for 1 to 3 months have a higher chance of succeed and return over selling it for every week over the same period. Let's go to Robinhood and see a few examples about every trade and the potential return. So as you can see, my account Friday has been a good day for me. It have been a good positive day. I went over 5,000, so that's great. Now let's take a look at some example of gambling. So first, you can see here in my account, I have an options on AMC and I have an option on this new company, OKLO. These are both, I have labeled them as gambling. Even the option that I have on AMC have been successful over the last 2 to 3 weeks, is still nothing more than gambling. And I'm using all my gambling limits on a few names only. Let's open AMC and see what we have here. I started selling cash secure put on AMC when it was around this price, 8 point something. And you can check my videos about it. When I sold these options, I sold it so deep out of the money. I sold the $4, $5, and $6. The $4 put end up expiring out of the money. The $5 and $6, I was able to roll it over for a credit for a lower strike price. So I haven't get assigned yet, which is great. I'm collecting premium while waiting for the stock to either stay in the same price or go up or down in a small levels. As long as that continue, I will continue generating income without getting assigned and purchasing the stocks, not any more than I already have. So let's take a quick look. I have 800 share at 20.97. Currently, I'm down big time, minus 76 unrealized losses. If you can see, Friday's return was positive, plus 230. The total return is 1,241, and that's, of course, doesn't even include the other option that I have already closed and collected return from them. As you can see, I have May 31, 2 cover call that I have sold for that price, and currently it's positive. I don't anticipate the price to move to 7.5 in a week, but if it did, I would be able to easily roll it over, and I have a video explaining rolling over in details. Looking at the put, I have a put that expire also next Friday, and it's for $3. Currently, the price is way far off, and I think it should expire out of the money. I probably won't close it and wait for it to expire to collect the full premium. I have 3 calls for AMC that expire on 7th of June for $22. Again, these I'm expecting to expire out of the money, but in my favor, because I'm the seller of the call, and I will collect the full premium for it. If by a miracle or a short squeeze the AMC jump to 22, I have no problem selling this stock for that price. Next, I have 7 contract on AMC that expire in 1 month for the strike price of 5.5. Currently, it's in the money, but these are the one that I roll it over from $6. So I already saved myself from buying the stock for 6 and went back to 5.5 while collecting $35 per contract. That's 245 all 7 contracts. And I'll probably, as long as the volatility is still there and the price within the same range, I'll be able to roll it over again to a lower, maybe 5 or 4.5 next time. Or if the stock went up, then it will get expired out of the money and I will love it. Next, I have 3 calls for $20 that expire in 1 month, and actually I collected amazing premium here because I sold it just in the right time. So I've collected 250 per contract for 3 contract, and right now this contract I can close for $14, only have $42 left in it, while I have collected unrealized gain of 708. And lastly, AMC that expire in 5 weeks for $4 put. This is 4 contract. This is actually when I roll down the contract that I had before from $5 puts to $4, saving myself $100 potential loss in each contract. So at the end, it's positive for me. It's $15 per contract, resulting in $60 for this trade, $60 of credit. Going back to my account, that was an example of some of my gambling trade that I have been doing. And with OKLO, it's the only two that I have been playing as a gambling. The rest of them, it's either a trade or investment, which is the same thing that you should have in your account. So here you can see this has been a trade for a while, but I kept rolling over because it keep playing close to me. I have sold puts on Apple, and eventually I get assigned for about 180 after collecting premium 2 times. After I get assigned and I bought the 200 share, I start selling cover calls on it. I have explained in details all the credit that I was able to collect in my other video, which I will link to it on the screen. Another short-term trade that I did is on Amazon here. As you can see, I have call to buy for 150 and I have sold a call for 180. This one called a debit call spread. I have paid for it $22.55. Since it was already in the money, it cost me a little bit more. I have opened this contract on April 17. Currently, it's positive and I have unrealized gain of 382. I probably don't mind leaving it open for a few more weeks and see how it plays out. Hopefully, it stayed in the money and I able to collect the full premium for it, which should be 3,000. As for long-term investing, you will see that I have Apple, I have Microsoft, I have Google, I have Amazon, Netflix, SQ, PLTR. These are some of the stocks that I have a lot of money in it, and these are long-term investment. Lastly, I would like to suggest that you have a clear percentage between investing and trading, and if you must, gambling. Investing in this case, you should have most of your money anywhere between 80% to 95%. The trading will have the leftover from the investing, whether it's 20% or as little as 5%. The gambling, if you can do without it, if you're not a gambling man or woman, that would be great. But if you must, probably you shouldn't go more than 1% or even lower of your account. I hope this will help you clearly identify the different trading and investment that you can do these days and establish a clear line between investing, trading, or speculative trading, or like other like to say it, but it's just gambling. It's just you're using the stock market to gamble. It can be exciting and happy moment when you win once or twice, but over the long term, you're most likely to lose money. And that might set you back because it's going to eat up the profit you're making from the long term investment or the trading. And I don't want you to experience that pain. If you find this video helpful, please consider giving me a like and pressing the share button and subscribe to my channel. If you have any question or you would like to share more of your knowledge and experience with me, please feel free to leave me a comment. As always, the information provided in this video is for educational purpose and should not be constructed as a financial advice. Investing involves risk, including the potential loss of principal. Thank you guys. See you in the next video.